Welcome back to the twochimps.net 5-minute trading tips. I'm Jake Bernstein.
And I'm Elliot Bernstein.
We like to bring you information you can use, and we like to encapsulate it in a very quick overview for 5 minutes or so, and we enjoy you being here. Traders are very busy these days. They need good information, and they need it quickly, and they need it accurately. We can't pretend to give you everything at the 5 minutes, but we can give you some good ideas and open your eyes to new things that you may not be aware of. Today we're going to talk to you about the COT report, the Commitment of Traders report. Commitment of Traders report is available every week, and it shows the positions, long and short, additions, changes, etc., of major traders, called commercials, large speculators, called large speculators, and small traders, called small speculators. In addition, there are other various categories. What the report does is simply this. It tells you how much positions have increased on the long side or on the short side, how many positions have changed. So as an example, looking at the chart on the screen right now, we've got the COT commercials being the largest group of traders who use the stuff, who grow the stuff, who buy the stuff, who broker the stuff of which commodities are made. And it's showing their net positions long and short. So the green lines on top show commercial buying, the red lines on the bottom show commercial selling. We know that commercial selling is a hedge. So generally, commercials will be hedged against the product they actually own. Therefore, what's showing in red at the bottom of the chart is not really a short position, it's a hedge position. So if you look at this chart and you say, in this case, coffee, for example, all the way up in this great big bull market, one of the biggest bull markets in coffee history, commercials were short. They weren't short, they were hedging. They were taking product in from the producer and hedging it out at a higher price on the futures, which locks in a profit for them. What we're interested in is the anomaly, when commercials are buying. So as an example, notice, prior to this big up move in coffee, right over here, there was commercial buying activity very close to the bottom. Prior to this big up move in coffee prices, there was commercial buying sporadically over the course of several years. Prior to this move right over here, which was one of the biggest moves in the history of coffee, there was commercial buying again. These are tells, these are tip-offs that commercials need the product. And prior to the most recent big bull market in history, which started in 2014, commercials were net buyers for almost a year, actually for almost 2 years, straight through. So that leads to the question, what are commercials doing now? They're buying in coffee. Remember, this doesn't mean that coffee prices are going to turn right away. It means that they're accumulating positions. Commercials can do things that human beings can't. They can continue to buy all the way down and average down their cost because they have more money than God. We don't have that kind of money. So we need to use timing in conjunction with our tool. So we take the commitment of traders, we take a look at what's happening when commercials are buying, then we go to our timing triggers and use timing triggers to get in.
The important thing to remember about commitment of traders is that it's not a short-term indicator. It's used for spotting major turning points for investments and moves that could last as long as several years. Don't make the mistake of using COT for short-term trading decisions. If you're an investor or you're looking for major turns in the commodities market as a tool to invest in stocks that are related to these commodities, there's really nothing better than COT. Now I'll turn it back to Jake, who's going to give a couple more examples.
Take a look at the corn chart. This is a long-term corn chart, and I stress long-term. I want you to look at what commercials we're doing here before this bull market, here before this bull market, here for over a year and a half prior to this bull market, and again prior to this bull market, and now big buying over here, and where commercials recently were long again. There's been an interesting characteristic of commercial activity. Typically, when it moves from being long to being hedged is when the big bull markets begin. As a point of information, I've also put the corn cycle on here, showing how accumulation tends to happen by commercials at cyclical lows in corn. As an example, here, here, and here. Obviously, we're going to see what happens in this particular case, but some of these cases are very dramatic. For example, let me show you the wheat. Take a look at commercial activity in wheat over the course of the last 10 or 15 years. Amazing. Commercials have been long over 80% of the time, possibly even 90% of the time since 2004, and during that period of time we've seen some hellacious bull markets. Remember, put it together with timing. Now, in terms of the cycle, in future editions of 5-minute trading tips, we're going to give you some information on cycles and how to find them.
The COT is available free of charge at the U.S. Department of Agriculture CFTC website. However, they provide only the raw data, so you have to contact your trading software vendor to see if COT is available on your platform. Since we use the Genesis Trade Navigator platform, we know it's available there.
Thanks for coming here. We'll see you again next time. Write us if you have questions. We'd love to hear from you. Thanks again.
Thanks.